Hello, left fielders. At LFI, you know our focus is on networking and education. Mark your calendars because we're going to have a full day of it dedicated to you, our limited partners, at the Best Ever Conference on April 9th in Salt Lake City. Left Field Investors is opening the BEC with Passive Investing Mastery, an event focused on passive investors. This will be where insightful content meets passionate LP investors. If you enjoyed BEC last year and the meetup in left field this year, imagine them both back to back. The Best Ever Conference isn't just any event. It's the premier conference for commercial real estate investors and operators. Your ticket to Passive Investing Mastery includes admission to the entire Best Ever Conference from April 9th through the 12th. Join us April 9th, where we will have a packed agenda with sessions focused on how to be a successful limited partner led by experienced LPs, top operators, and partners. Then immerse yourself in the full Best Ever Conference, where you will be surrounded by like-minded investors, operators, and industry experts for unparalleled opportunities for learning and networking. The best part, and there are so many, but the best part, you won't find a bigger discount on the regular ticket price than the one you get for being an infielder. That's more content for an exclusive lower price. Register for the event today at leftfieldinvestors.com/BEC, and we will see you at Passive Investing Mastery, presented by Left Field Investors at the BEC.
It's so important to invest with experienced sponsors because, look, and sponsors have skin in the game. Because at the end of the day, if you've got a sponsor who's experienced, you've got a sponsor who's put, not an insubstantial amount of capital next to yours, and that's certainly been our philosophy at Clear Capital, watch what we do. Now, there's still that uncertainty. There's no question. I think one thing to keep an eye out is really making sure that the sponsors with whom we've all invested have executed.
Hello, left fielders. Welcome to the Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go. I'm really excited today to have Eric Sussman with us again and again, this third time. He's a founding partner of Clear Capital. He has over 25 years of real estate experience. He's an adjunct professor with the Big Ten conferences, UCLA Anderson Graduate School of Management. He's previously on episode 21 in July of 2021 and episode 60 in April of 2022. So we are super excited to have Eric back. Eric, welcome to the Passive Investing from Left Field podcast.
It's great to be back. They say the third time's the charm for marriage and to appear on your podcast, Jim. So it's good to be back for a third go round.
That's perfect. I was actually expecting some dig against the Big Ten, but you can't do that now that you're with us. We'll talk about that later, but I'm sure you're fired up about that. If you could, the first thing I always want to know is your journey. Now, you were on 2 episodes already, so if they really want to know about you, they can go back and listen to those episodes, which will be in the show notes. But give us kind of the Cliff Notes version of your journey into real estate and to the Big Ten.
Sure thing, Jim. Yeah, it's I guess a lot of paths that we've all had professionally are a bit circuitous, and I think mine checks those boxes because to live really I've had careers in 2 fields in parallel, full careers really, both in sort of academia over at UCLA Anderson. To my knowledge, I'm the only professor in the country in both accounting and real estate, so kind of a weird thing. My mother's very proud of that. And then, I'm the managing partner of Clear Capital. As you said, we're as many of you know, value-add multifamily folks, sort of in our part of the country. Yeah, we haven't really gone east of, I'm not sure what the dividing line is, but where the Big Ten begins, I guess. But, I started out my career after graduating from UCLA. It's amazing that I'm a faculty member at the school I went to college, where I went to college, which is sort of cool. I got my CPA. So I started my career at Price Waterhouse and then made the transition to real estate after Stanford Business School in the dark ages about 30 years ago. And the rest is sort of history. But anyways, it is great to be back with you. Obviously, we were joking, Jim, that the times, whenever we seem to chat, there's always stuff going on. And my gosh, was it 2 years ago that we last chatted? It's amazing, what has changed.
Yeah, well, again, I love these episodes because, and I recommend everybody check out your newsletter. It's phenomenal. It comes out every quarter, and it's just got charts and graphs and explanations. And it's also fun to read because you're a funny guy. So you get entertainment with education, and I love that. So I want to do a couple of updates from the last podcast. And this was, you were actually on last spring of 2022, and you said that Powell needed to thread the needle to control inflation. So the question is, did he do it?
It's amazing. If you had asked me to handicap the odds that Powell would have somehow given us a soft landing somehow, I would have said you'd been, probably, I don't know, maybe inhaling some of California's finest, or I would have put those odds at a pretty slow number. But, so far it looks like they've done it somehow. I mean, the U.S., economically is in the best shape in the developed world. GDP is positive. We haven't had that R word, even though, it's sort of on everyone's tongue and we're wondering if it's going to happen. But let's not kid ourselves either. I mean, it's maybe been a soft landing, but for those of us in commercial real estate and in multifamily, I'm not sure the landing has yet really been determined. It's still out there because of, again, the increase in interest rates and sort of the pummeling they've put us through. But it's amazing, Jim, if you look at the equity markets. In fact, I had this graph. I can't really use it on the show, but it'll be in my next newsletter. It shows through July. So that's the latest I have the data of like every asset class. You think about it, from crypto to this to that, and it's all green. Pretty much every asset class is sort of green this year. And if you'd asked anyone to predict that, they would have said no way. In fact, the equity markets have essentially recovered, and then some, the losses from last year. That just is stunning to me with rates going up. It's sort of nuts, actually, and sort of surprising. So far,
yeah, but
Powell, the seamstress. What's the male version of seamstress? I don't know, the seamster.
Yeah, I guess
the seamster has seemed to have done it. We'll see.
Well, so the data shows it, right? But I don't think anybody's feeling it. Investors are still concerned. Consumers, they still seem to be spending. But, if you ask anybody, how's the economy or how are things going? It's like just disaster after disaster. But when you look at the data, it's unemployment is at historical lows, all this stuff. And so what's the disconnect?
It's like it's mixed news, mixed emotions. What's that old joke that the definition of mixed emotions is seeing your mother-in-law drive off the cliff in your new Tesla. You're absolutely right. I think, look, the way investors are feeling, you captured the right word. It is uncertainty, and that is the right word because there's still so much uncertainty that remains. In terms of what might transpire, what might happen as we think about going forward. Geopolitically, I think part of it is the media. Let's be honest. In an election year, a lot. I'm sure your listeners get their same with me. We get our information from a number of sources, and I think the media, of course, benefits from uncertainty, benefits from conflict, and so they're doing everything they can to keep that up. But I think that, again, it's still uncertain, Jim. I mean, we've had this incredible increase in rates. There's a lot of loans, commercial loans, that are coming due. $1.5 trillion, let's say, depends on how you measure it, the next few years. And a lot of those loans are either underwater or going to require significant cash in upon refinance. And so it kind of remains to be seen. Transaction volumes in real estate are way down in every sector. There's this sort of price discovery going on between buyers and sellers and the rest of it. So that's adding to a lot of the uncertainty. And I'm sure we can go into more detail on all these things.
Yeah, and when I guess this question is probably unanswerable. In your most recent newsletter, you said the word uncertainty was used 60 times in the IMF Global Economic Outlook. Mm-hmm. So my question is, when are we going to be back to certainty? Are we ever going to be certain?
There's no such thing, right? What I say is that look, the sun's coming up here in Southern California. I apologize. You can see the wrinkles more clearly. I'm not sure that's a good thing. I'm not sure there's ever certainty. So it's all sort of relative. And I've used this line many times, and I'm sure this will resonate with a lot of us, is that when there's consensus, when people the pundits all sort of agree on where the economy is headed. The likely outcome is something completely different. There's lots of examples on that, and maybe a little bit trite, but I think there's some truth to it. So look, I mean, there's never anything such as certainty. The markets are uncertain. I mean, of course, geopolitics uncertain. It's just, I think right now, because of the geopolitical environment, the national political environment, inflation uncertainty, it's magnified, these days.
Well, let's talk about some of the specific uncertain things, right? Like interest rates and rate caps on, commercial deals when someone's going to get a new loan. Can you talk about just what is it like out there now? How has it changed, and where do you think we're going?
It's tough, Jim. It's absolutely tough, and you have to sort of course, in any investment, sort of think about the debt markets and, of course, equity investors, and the folks on this podcast, and we're equity investors. We're behind the debt, but the debt market, again, has changed so substantially over the times that we have spoken. So you have to sort of think about, obviously the increase in interest rates, that's sort of a given, but the underwriting has changed. The spreads have widened in the uncertain market. Lenders have increased their spreads. Loan to values, where, let's say, in our deals, maybe we could get 70% loan to value. We're at, sort of 60% loan to value. And of course, the whole fixed versus variable game plan, right? In our space, look, value add, folks. I don't care if you're doing value add in industrial, office, retail, and certainly multifamily. In any business, you match the debt with the business plan, right? And so when you're doing value add and the goal is to improve the project and increase rents and increase NOI and then do a recap, getting fixed rate financing really didn't make much sense. You get floating rate debt to match the structure. You hedge that to some degree through those caps, as you mentioned, and then hopefully you execute quickly enough. And if there is an increase in rates, you're hedged and you're getting an increase in NOI to offset that. That's the whole business model. But when you have the kind of increase in rates that we had, that has wreaked havoc on interest rate caps and the cost of those caps tied to variable rate debt. And even if you're hedged, you still have the delta between the rate, the initial rate on that debt, and the cap rate, the ceiling. And so, people in our space across the board are facing much higher borrowing costs, more challenging refis. And when those caps expire, got to renew those, and those are much more costly now than they were. So those are a few things to chew on, for sure.
Yeah, well, talk about the interest rate caps then. So the pricing for those has gone through the roof. And again, I don't want to make this whole podcast about uncertainty, but is that why, it's not the interest rates are not historically high right now. They're just a lot higher than they were a couple years ago, and it went so fast. So is that the problem with the rate caps and why they're so expensive?
Yes. I mean, think of it as the difference between, sort of velocity and acceleration for my physics or science-minded folks, right? You have, velocity, which is an absolute metric. How fast are you going in your car? How high are the rates? And Jim, you hit the nail on the head, right? You look at the graphs, and many of us have the scars, thinning hair, and wrinkles to remember the 70s. Or you've heard my joke, those that lived through the 70s, you don't remember it. But, rates were much higher. But the acceleration, the change in velocity, right? The change in interest rates, that's been historic. I mean, going from 0 to 5.5% on the Fed funds rate in 22 months, nowhere near. That didn't happen in the 70s or ever in our history. So it's that change which is really wreaking havoc. Obviously, yes, the absolute change is creating a higher costs across the board, but then it's that delta, which adds the uncertainty, where are rates going, and derivatives always are, very impacted their value by, again, changes, and that increases the risk.
So can we expect, let's say that, interest rates don't get increased much more, right? They're talking about one more raise and then maybe a flattening. If that happens, and it just stays flat for a few years, maybe there's a couple dips or something, is that when these things become more reasonable? Because you can still make money at 5.5%, 6%, 7%, right? I mean, people did that in the 80s.
Of course, that's exactly right. I don't think anyone thought rates were going to stay at 0. We certainly didn't. You hedged. But again, if you'd asked me, whether I thought rates would go from, again, 0 to 5.5% in the blink of an eye, I would, again, said you were nuts. In fact, the Journal every year at the end of the year, Wall Street Journal, interviews and surveys economic pundits. I'm still not sure what a pundit is. I'm hoping to add that to my CV at some point. But, these professional economists, the head of, the chief economists at B of A and Wells and Goldman Sachs, and they asked them, to survey the rates. And they were all so far off, it's comical. So, I think it's that change. Now, looking out, you're right. If things say, again, we have sort of normal increases or things stay steady and yet the economy remains on a decent path, real wages continue to grow but not excessively, energy prices stay in check and the whole 9 yards. Yeah, we can have that soft landing. The needle would have been thread. And, if lenders will work with borrowers that can do so and get through it, history tells us all will be fine, but you gotta, stay alive to 25 or whatever the trite thing is, and
right,
it's going to be, that will remains to be seen. It'll make things interesting, and that's, I guess, the spice of life.
Yeah, exactly. Well, so let's talk about inflation. I know, there's been supply chain is the reason for inflation. The pandemic's the reason for inflation. The interest rates, insurance costs, like. Is inflation? Have they beat inflation?
No, they haven't. This is like Muhammad Ali and Joe Frazier. There's like 3 different fights or something, or George Foreman, and I'm not sure, maybe in the first one. I mean, and look, you hit a lot of the things that have happened. Of course, COVID, unexpected. Russia's invasion of Ukraine was incredibly inflationary because Russia, supplies some like 3 or 4 of the leading producer and supplier of certain metals to supply chains. Of course, the largesse and the Fed's printing money like it was going out of style. I mean, Inflation Reduction Act is probably the most, euphemistic thing. I mean, government spends, I don't care how it is, it's going to be inflationary, but it sounded good. So look, to get back to the 2% Fed target is still, a ways away. You may have read this morning, the ECB, the European Central Bank, raised rates to record highs this morning. So, we're impacted by that. Well, it's a small world after all. There's a lot of moving parts. I'll add one other thing that's kind of also increasing rates, just a tidbit. Some of all of us might be interested in, and the media sort of doesn't talk about it very much, is that if you look at the net holdings of treasury bonds by the biggest 3 holders, which again, China, Japan, and several others, they've reduced their holdings in our treasury bonds. Some of that maybe Saudi Arabia was one I was going to mention as well. They've reduced their treasury bond holdings, and we can talk about why that is, but that's sort of interesting. And that has had an impact on rates and our ability to sort of fund our budget deficits as well. There's a lot to unpack there. But anyways, the short answer is the Fed's not done yet.
Right. Well, what does that mean when they reduce treasuries? I understand what it means. What's the effect? So if they're buying fewer treasuries, what does that mean for investors? What does that mean for interest rates? Because it all cascades into everything, right?
Yeah, it's really weird to think about, interest rates is a price. It's a price of, again, the supply and demand for interest-bearing financial products. That's what it is. So when central banks, China, Japan, Saudi Arabia, and others are selling treasury bonds for whatever reasons to bolster their currency, to actually create some political uncertainty in the United States because they may have certain wishes for a certain administration. That, again, reduces the price of those bonds, which the inverse, that increases their yield. So it's hard to disaggregate that. I mean, how much of the increase in interest rates has been caused by the sale of the monetization of U.S. Treasury securities by these large central banks, but it's not insignificant. And it's concerning, as I said, because we've got budget deficits, which is, I don't care what side of the political aisle you're on, that's an issue we should all be concerned of. And how do you fund those? You have to sell debt. Well, if the big folks ain't buying or are demanding higher rates to take a dip in that, in that pool, that, again, is inflationary or increases rates.
And what's the effect then on the dollar generally? Is this, some of those countries are, I guess China maybe is the one in the BRIC, right? That maybe you can talk about that. Is the dollar in danger? It seems like everyone's talking about the BRICS are going to go out and replace the dollar, but who's going to rely on China to use their currency, right? So it doesn't make sense.
I wrote about that, Jim, in I think it was my Q1 newsletter. I gave a spiel about that, I had read all these pieces. The U.S. dollar is on its deathbed, it's entering hospice or something like that. And that again, that's great media fodder. It sounds great, but that's a lot of bull. I mean, and look, speaking of China, right? People say, the RMB is going to replace the dollar. Okay. Have you seen what's going on in China? Are you nuts? China has currency restrictions. They don't allow outflows of currency. You can't become the global currency without, sort of, again, get a little wonkish, about very low economic and transactional frictions, costs. So, if you don't allow currency out of your home market, it's impossible. So that's a lot of BS. But sure, Japan, especially with the yen, I think in some cases have sold U.S. dollars, U.S. treasuries to sort of bolster their own currency. But that's not happening. They're not replacing the dollar and the euro. I mean, you must be kidding. So look, those are, great headlines and taglines to, clickbait kind of stuff, but it ain't happening. So don't believe that rhetoric.
And China also has huge demographic issues, right? So people talk like China is going to replace the U.S. as the global power and all that. But how does that happen when their demographics just are not working for them?
Jim, you're answering your own question. It's great, but we both love to hear ourselves talk. It's good. No, I know you hit it on the head. But let's not. Okay, so let's unpack that. As far as China specifically, a couple data points. China's population declined last year for the first time in 80 years. Okay, so China's population declined, but again, that's not unique to China. It's the developed world. Look, the entire developed world is not replicating the way it used to. If you look at basically the children per couple, it's basically at 2.1 right now. We're heading downwards. Look, we've all realized what a pain in the backside children are, how expensive they are. You gotta educate and feed these creatures. God,
right.
And they sure get in the way of a lot of things. But in any event, it's not just China. So, Japan has gone through that demographic horror show. China's there. The United States is basically within, as I wrote, and I think demographers sort of agree, within 3 to 5% of peak population, unless we get immigration fixed, and that's a political football. So it's a real issue, Jim, across the developed world, certainly in China. That, by the way, I'll just interject, is very deflationary. So you think about what happened in Japan and price decreases, population declines are deflationary. So that's a big macro trend. Of course, that's over years and decades, but a lot to unpack and keep an eye on there. Great question.
And so I want to move a little bit then into actual real estate. The big thing everyone's talking about now are distressed assets, distressed multifamily. If you're an operator and you're not going after distressed assets, then what are you doing? So a couple of questions with that. What does it mean to be distressed? Is that the only thing you can buy now? Is that the new value add, is distressed real estate? And then are lenders going to work out loans? Or are they going to start owning all the multifamily apartments in the country?
Yeah, I mean, okay. Distress is being a UCLA football fan many seasons, but I mean, distress. There isn't a definition of distress that I am aware of, either in academia or in the real world. I guess it's sort of like that old definition, when you see it. I think distress obviously has a lot to do with operating cash flows from any asset versus the levels of indebtedness that's tied to it. And right, just because of the increase in interest rates we talked about later, even if an asset is performing well, it's probably at some level distressed, because if you were to either sell or try to recapitalize the asset, the capital structure, you're likely to have to, put cash in, take a loss right now. Now, would that mean you lose the asset? No. I mean, if you've got fixed rate debt, you're probably okay. You've taken some paper losses. There's no question. That's just, I don't care what asset class you're in, because the NOI hasn't been able to keep up with it. But will the banks own everything? No, I don't think so. Certainly, there are going to be some tough decisions that banks have to make. In fact, I teach an entire class on workouts and distress. It's been a pretty boring subject the last decade, but boy, now it's becoming timely again. And, lenders have to look at a lot of different factors. I have a whole kind of framework for if I'm a lender, how I think about whether I should work with a borrower and, be patient and sort of extend loans and with certain other, quid pro quos, or do I, hey, hand over the keys, it's over. That is going to be, asset dependent, borrower dependent, sponsor dependent, guarantor dependent, and a lot of different factors going into that. And again, we can discuss each, in detail if you'd like, or as much time as we have.
Yeah, what I'm curious about is, we're LP investors typically, left field investors. We're LPs, limited partners on these deals, so we have no control, no say. We just, we're on the boat and we're going where it takes us. So if we're analyzing the deals we're already in and what we should do about them, is there anything that we should be looking at, or if this bank might be a better bank to work out the loan, just so we know what's coming? Because it just seems like we can't do anything, but I feel like I should be informed on some of these assets I'm in that might be shaky.
Yeah, no, I'm with you, Jim. That trade-off of transparency and this and that. I think, to me, watch your sponsors. That's where, again, it's so important to invest with experienced sponsors because, look, and sponsors have skin in the game. Because at the end of the day, if you've got a sponsor who's experienced, you've got a sponsor who's put, not an insubstantial amount of capital next to yours, and that's certainly been our philosophy at Clear Capital, watch what we do. Now, there's still that uncertainty. There's no question. I think one thing to keep an eye out is really making sure that the sponsors with whom we've all invested have executed. It's one of the things that lenders look to. I mean, if you haven't executed on your business plan, your value-add business plan, improved units, improve the common area, increased NOI since the time you've invested, that's not a good sign, honestly. That's something to ask or inquire. Why hasn't the NOI gone up? Because, again, the fundamentals are still there on the numerator piece. Occupancies are still fairly strong, certainly in multifamily. Now, suppose you've invested in office and all that, well, that's a little dicier. On the multifamily space, it's really about has the operator executed on their plan, at least in part, to improve the asset, and increased NOI. Because if rates come down, and again, we get sort of a normalized, sort of situation, and you stay alive to 25 and 26, things should be fine. You got to hold on. But again, that's why you want to be with sponsors with, for better or worse, the wrinkles and the gray hair. They've been through some cycles. And I'm not saying that in a flattering way, frankly. It's just the reality, because you've been through these before, and that experience will be really, really important.
And how do we evaluate sponsors based on experience when, some of the very experienced operators got it so wrong, right? They're doing capital calls that they're blaming things, some of them on pandemic, interest rates, all these things where they didn't execute the business plan like you were talking about. And so you might be getting capital calls, you might be losing some of your equity. How do we change our evaluation of an operator, of a sponsor, knowing that they're super experienced, but maybe they didn't get through this as cleanly as they could have? And it's, I understand some deals aren't going to work out, right? But when it's operational, the business plan didn't work, I have a problem. If it's interest rates, okay, I understand, we missed it, we didn't get it. Does that make sense, what I'm asking?
Yeah, I do. And that's why, again, we talk about controllable and uncontrollable things, right? What's within any sponsor, any investor's control? It's true as limited investors, and I'm a limited partner in Lord knows how many partnerships and LLCs, not just Clear Capitals. Many of my former students they have some distress too in some of the projects. You do have to distinguish between, let's say, look, that what happened with interest rates. That, again, I don't care. I talked to a gazillion people with even more gray hair than I have, and no one got it. No one predicted that. So, that's unprecedented. And that's why even we glossed over and talked about it, but what happened in the spring with the banking, the fastest banking crisis in my career, it's not over yet, by the way. That's with very experienced folks, First Republic Bank. I mean, that's where we do our banking. We're talking very seasoned folks. So you really do have to find out. I'd ask, okay, in your original business plan, you said you were going to improve, renovate 30 units. How many have you renovated? What has been the delta before the rents before and the rents after versus what you pro forma'd? Okay. That's the control part. That's the part with the sponsor. Have they done it? Okay. You said you were going to add a dog park. You said you were going to, add cabanas to the pool area. I mean, whatever the darn business plan was, did check those boxes. You can find out if you're able, and some of you guys all can visit the properties. If they're within your geographic areas where you live, go check it out and see what they did. But distinguish between that and things like interest rates, like insurance costs. Jim, you mentioned that earlier. I mean, no one predicted insurance premiums to go up 20.4% year over year in Q1. 20%. If they didn't cancel your backside, okay?
Right.
In Florida and California, so those were not foreseen, wildfires and hurricanes, and maybe we should have, but I mean, acts of God. So I think distinguishing those two things is critically important. And I would add one other thing. Look, I can tell you Clear Capital. We made our first capital call ever. Never done it. Okay. But I wouldn't do it if I didn't think it was this asset was worth, and we increased the NOI. We have executed, but it's, we all like receiving distributions. No one likes writing checks. So it's not taken lightly. But it's where we are in this particular cycle.
Right. And I think capital calls, like you said, they happen as long as you're responsible and transparent and informing. I've been on both sides of this. I've had a few capital calls, and some I've been okay with because they've been completely transparent, all along the way. Hey, this is why we're doing it. And others were like, hey, you're in a couple of deals. Everything's fine except for this one. And then 3 months later, well, there's a few more. And then they just keep dribbling out the bad news. And that is not the way to receive bad news.
Yeah. In defense of those sponsors, and I can't speak for them, it's hard to, as you said, Jerome Powell is threading a needle, and so are sponsors to some degree. I mean, this is all sort of new and unprecedented. It's a horrible freaking word. I hate that word, unprecedented, but, these acts of God, we call them in academia, sort of 4 Sigma events. I think for those who are statistically minded, so how do you sort of pass on whatever news when it's changing so rapidly and things are unclear? But like I said, the one thing, again, if the sponsor is skin in the game, like, for example, on our capital call, we had one. I personally wrote a check, a good sized check, along with everybody else, to put money in. And that's the other thing. Are the sponsors, putting their own money where their mouths are? I mean, look, talk is cheap. So look, you want to, I can tell you it clear. We're putting I have put my money where my mouth is, and that whatever pain investors may be suffering, Lord knows, it's felt by yours truly, and I'm sure I'm not alone in that. But if your sponsors are all talk and no cattle, or what's it, all horse and no cattle? I'm in California, so we don't have those things. If you're all surf and no surfboard,
there you go.
I'm not even sure that makes any sense. Then and sponsors are not. Aren't doing, then I think you need to take a real harder look and say, well, gee, do I, make that capital call or not? And just, take the dilution that comes and see what happens. I can understand that dilemma.
Yeah, it's a tough decision to make, whether to participate or not, and just to evaluate. But you mentioned in there when you're talking about banks, and you kind of said, it's not over yet. Can you expand on that a little bit?
You used to be able to say it's not over till, certain individual sings. I don't think you can say that these days. So it isn't over because, look, I gave, and if your viewers are interested, I'd love to be connected with y'all on LinkedIn. I do publish a lot of stuff on LinkedIn. I did a whole hour video on the banking crisis, which I'm sure is still up, and I share as a teacher, as a professor, I try to be very transparent, and I'm very much on engagement and education. I did a whole hour, so I can't possibly summarize that. But look, it comes down to some simple economics, the two sides of any bank's balance sheet, right? You've got your deposits with folks like us, and I'm sure, if you're on demand deposits, you're still getting somewhere between jack and squat. But if you look at the cost of funds on CDs and other money market accounts, banks are paying, north of 4%. You just have to ask them and make sure you move your money and, from zero. So that is costing them a lot. On the asset side, two things are working against the banks. One is all of the loans that they've got, unless they're truly in real time floating, they've had losses themselves on those fixed rate loans. They've lost money and lost. That's what did First Republic in. Too much fixed rate, long-term fixed rate loans that have just declined terribly in value. Same with long-dated treasuries. Any kind of loan has taken a hit. On the floating rate loans, they usually have a lag. There may be some, again, that's where sponsors are getting hurt, really. And so that's where any distress they've got is coming from those floating rate loans as well as the fixed rate loans to some degree. And again, they're not making loans. There's the lending activity is way, way down. So operationally, they're having struggles. So it's a combination of things. And what was the Men's Warehouse commercial? I guarantee it. There are more bank failures coming. I guarantee it. And I'm not saying that be tongue in cheek or humorous. It's not a good thing. And that's the Fed has got to be mindful of that. Their interest rate sledgehammer works on all sorts of ways, and banks are not immune. So they've got to be very mindful. And again, that's another needle. They can't have crisis. They've so far controlled it. Silicon Valley, Signature, and another regional bank I'm forgetting right now. But again, it hasn't been widespread. Good for them. They backstopped deposits.
Yeah. So you mentioned, interest rates you can get from a bank, 4%, maybe a 6-month CD, you can get 5.5%. Why does it make sense to invest in multifamily when, people are paying me 5 or 6% cash flow on a risk asset when I can go to the bank or get a CD for 5.5%?
We hear that every day, and it's a reasonable question, right? I mean, everything's about opportunity cost. There really is only, probably a few reasons. I would say one is reinvestment risk. I mean, so you said 6 months, right? So yes, on a 3-month treasury bill, I haven't looked in where they are. 5%, but obviously, you have reinvestment risk. So to the extent that rates decline, which they will, I have no doubt that they will. It's just a question of when. You have to reinvest those money. The party won't last forever. But I can certainly understand the temptation there, and certainly it's not for some of your capital makes all the sense. And we all need to have cash reserves. That should be in money markets. You don't want to leave those in CD in your regular savings account earning that point. Where what you're earning is to the right of the decimal point. So that's an easy one. But the second thing is really growth, right? I mean, the whole point of investing in any sort of more risk-based investment, whatever it is the growth in cash flow. So, you may be earning, let's say, whatever the yield is nowadays. Let's say you're at a 4 in today's market. Which you're right is below the short-term rates, but the whole point is that's going to grow. I think that will grow over time, which the opposite is true with the cash on hand. And look, history tells you it's in the most uncertain times where investors do the best, but it's really, really hard to invest in uncertainty. I mean, again, it's when is it easiest to raise money for our business, for any sponsor? At the market peak. It is. We can sugarcoat it. It's true in the equity markets. It's true in real estate. It's true in everything. It's hardest when it shouldn't be. So in fact, when it's difficult is usually the best time to invest, and history tells us that. So it's about balance. I agree. You got to have liquidity for all the uncertainty. You want to take advantage of the higher rates. And so I think you're onto it. But you got to keep investing. Just be more selective and mindful of what you're investing in.
So to be mindful of the investments, like we're talking multifamily. You're a multifamily operator. So if I'm an LP, considering all the uncertainty we've talked about, what's the most important metric or a couple of metrics to consider when I'm deciding whether or not to invest in a particular multifamily deal or the asset class generally?
Yeah, I don't think that, again, I get asked that question all the time, even in class, what's the one thing? I don't know if you remember the movie City Slickers, right? Again, I am dating myself again. Curly, right?
I remember.
Life, you got to remember the one thing, right? There's never any one thing. I sort of am a macro. You've read my stuff. I tend to go macro to micro because the micro is almost impossible to predict, right? What is the Fed going to do? Are people going to start having more children because of tax incentives or whatever? I mean, it's just hard to predict. The macro, to me, it's the difference between renting and buying. And right now, we are at record highs in terms of the delta between the cost to own a single-family residential home and to rent a unit. And it's not shocking, right? Because of the mortgage rates. So what's, impacts the goose, impacts the gander, while multifamily is affected. I mean, 30-year fixed rate mortgages have gone from less than 3% to, a couple of years ago to, we're now at close to 7.5%. I mean, the impact is unreal. Meanwhile, of course, single family home prices haven't really gone down. There's reasons for that, where rents are basically flat right now, if not even down year over year, just marginally. So the cost to buy and cost to rent, to me, I look at. So that factor is huge because I know the need for rental units is very high. So I look at that. I look at, of course, units coming out of the ground. We've had, lots of supply coming out of the ground in certain markets like Atlanta and Austin, for example, Nashville, and therefore rents are falling more sharply in those markets. Other markets, there's still rental growth. Midwest has done very well. We're not in there, but Midwest has actually seen some rental growth. So, I look at those factors broadly, and then I look at sort of, okay, where is the asset? What does the local economy look like? What are the drivers of industry, job growth, wages, and so forth? I'll give you an example, Jim, that just, again, I don't like to, just to highlight the issue. I just read that Microsoft is not renewing its lease for its corporate headquarters in Bellevue, Washington. All right. It's 750,000 square feet. Now, I'm not sure if I haven't read all the details. I assume it's because of hybrid working and whatnot. So the impact on, Seattle's already seen, real drop in rents. And I wouldn't want to be owning units in Bellevue, Washington, anywhere near Microsoft's headquarters. I guarantee you, people are going to try to sell, not realizing that's not in 25. So you have to really understand the drivers of local demand for units, not get yourself tied up with, one industry and one driver. And then, look, it goes the same things we've talked about, but, sponsors and everything else. But that's what I look at, broadly speaking. And then, the rental opportunity and value add, of course, what is the current rent and what can it be based on the comps and how much is it going to take to get there?
Yeah. And then Clear Capital is in not the standard markets. And I don't mean that in a bad way, right? It's, it seems like when I see deals coming out from you guys, they're in states that sometimes we don't normally see syndicators operating in. So can you talk a little bit about how you choose a market and what you're looking at that might be different from others that are, in the Phoenix, Dallas, and those kind of places?
Well, we've looked, we've had assets in all those markets. Look, we're more just geographically focused. I'm sitting here in Westwood, California, West Los Angeles. So, our roots are here locally, but, and we have a lot of assets in California. I still like California. We're still the fourth largest economy in the world, for God's sakes, despite all the rhetoric. Again, that's media. We're not all downtown San Francisco or Union Square area there.
Right.
But California's got some challenges. So we've invested in, Oregon, Colorado, Arizona. We have had assets in Texas and Utah, and we still do. Part of the other thing is we look at, when we look at a market is where I know I must have used this saying before with you, Jim, it's the Wayne Gretzky quote, which where the puck is going. But look, demographically, population has left the coasts and will continue to leave the coasts. I've called it, again, my wonkish way, manifest destiny in reverse. I'm sure I've used that with you too. So people are leaving California for less expensive pastures, maybe less bureaucracy and red tape. We're good at that here in California. So, we have invested in those markets. We look at, where is industry, where job growth happening? And that's one thing that's happening in the United States, I think, is onshoring of industrial and supply chains. That's one benefit of COVID to the country is, I think we're going to see more manufacturing here in the States. And that's going to be great for unions and jobs, of course, on the day where the UAW is threatening to start striking here. So we look at where jobs are, what's driving jobs, what are what does supply of new inventory look like? That's been plaguing, of course, markets like Austin, Nashville, Phoenix, where a lot of new units have come on board. But there's a lot of growth in those markets too. So, you have to look at all these data points and try to buy selectively and go from there.
Yeah, I always like it when I see someone that's doing business in a state that I don't have a whole lot in, because that gives me a little bit more diversification. So that's part of the reason for that question. But we're kind of getting up to the time here, and the last question I always ask, I'm not going to ask because I know you're not a podcast listener, although you are a great podcast guest. So give us a book that you've read recently or a good source for economic news.
Gosh, the main thing is I have to be honest. Okay, this is let my therapy session begin. Now, I am not a big book reader. I think because I read so much stuff, and I really thank you for the newsletter plug. That's really my biggest plug. As an academic who loves to sort of engage and think about things deeply, I really do, but in a way that I hope is reachable to folks. And again, that's all. It's available on LinkedIn, so you don't have to, subscribe to anything. Just connect with me on LinkedIn, and I'd like that anyhow. I read so much stuff. It's nonstop. The things that I sort of read, the blogs that I read. There's, even on Twitter, or dare I say X. I follow some very smart folks that I think are worth following. If I had to choose one, I'd probably have mentioned it. If I had to read one publication, and just one, and I do, it's The Economist. I think The Economist, it is, I'm telling all of you, it's the best thing. And again, all of our times are limited. We don't have enough time. The articles are short. You can kind of skim the headlines and get a real sense. It covers the globe. It covers economics, business, banking, finance, demographics, social issues. It covers like everything, and everything affects real estate. So I encourage it, and you'll see a little tidbit that might, that's an interesting article, and they're short. They're no more than usually a page. So you get it in small bites, which is really great for all of us. And I'd have to say, I will tell you, I know this is so self-serving. It's ridiculously self-serving, but I think my newsletter, if you skim it, it covers a ton of stuff that people can kind of look at. And it's because of my wiring. And I don't think Warren Buffett or Howard Marks from Oaktree are shaking in their shoes from the newsletter world, but that's where I do my podcasting. I sort of do it through that means, and maybe in the written word as a professor type. But I know those are some thoughts.
No, that's great. And I think The Economist has a great podcast. And I like that because I can listen to it at 2 or 2.5 speed. And that's a lot faster than I can read. So I would recommend you turning your newsletter also into a podcast and just have somebody read it. It'd be fantastic. That I could do it 2.5 times and I'd get it all in. But the newsletter is fantastic. I don't mean to overplug, but it is a great source of economic news, and it's also presented in a way that you said it's easy to digest and funny, entertaining while you're getting educated. And if you're going to get entertained and educated at the same time, I'm all for it. So I love that.
One of my students told me years ago, said, Professor Sussman, you're an edutainment. I said, well, to me, education is truly a gift. It's the gift that all of us have, and we don't value it enough. In fact, I tell students, they say MasterCard is priceless. Bullshit. Education is priceless, really. And of course, it is expensive in the real world, but it doesn't have to be necessarily if you're someone who seeks it. So I appreciate it. And I'm irreverent. In another life, maybe Jon Stewart or stand-up comedy would have called my name, but unfortunately, Lorne Michaels of SNL hasn't called me yet, and So my comedy is left to my classes and my newsletter to some degree, but I think it makes it's the spoonful of sugar which helps the medicine go down when you're talking about boring things like yield curves and
Absolutely.
interest rates and demographic data or whatever the heck you're doing.
No, it's great. And look, we appreciate you being on the show. I think you've been on summer, spring, and now fall. So we'll have to get you next winter and see if all your predictions, which I guess you made a few of them. The last time you made a prediction on the podcast, though, you picked then Pac-10 UCLA to win the national championship. I might have goaded you into that. They lost in the Sweet 16 to the runner-up. So that wasn't a bad prediction. That was on par.
It wasn't the Sweets. Didn't they make the Elite Eight, or was it the Sweet? Maybe it was the Sweet 16. I can't even remember. We was it Gonzaga? We lost. I can't remember. Look, I UCLA basketball. I'm always the optimist in chief. Hope springs eternal. If at Jim, one of my favorite quotes. I use it all the time. Is from The Shawshank Redemption and Andy Dufresne. Hope is a good thing, maybe the best of things, and or a good thing, and good things never die, or something like that. I'm hopeful. UCLA, we're ranked, I think, 22nd in football right now, and I think we're 24th in basketball preseason. So, hey, although I think our crosstown rivals USC on the gridiron has us beat this year, sons of bees. But Big Ten, we're coming for you, Ohio State, and Michigan.
Here we go.
It's going to be
right.
ugly. Jim, you're not. Where the heck are you, Jim? Remind me.
Ohio, Columbus, Ohio State.
I was going to say Ohio. Oh God, okay, friends of left field and Jim, give the points when Ohio State takes UCLA. Give the points. You'll cover, I'm afraid.
In football, maybe not in basketball. That's a different story.
We'll see. You had a few good years back then, but in the
that's true.
Anyways, Greg Odom and Conley days, if I remember correctly.
Yeah, they did all right. They did all right. One and done though. That doesn't. It's not sustainable, right? But I enjoyed that season. So, well, Eric, thank you again for being on the podcast. I really enjoy these shows, and I learned just a ton. So, if people want to get in touch with you, what's the best way to connect?
I would say, look, LinkedIn is great. I mean, and again, you can obviously find us through Clear Capital too. I mean, and register there. But LinkedIn is great, and I publish everything there as transparently as I can. And I love you do a great job, Jim. You really do have some great speakers on, and I learned too. So it's again, it's part of the education in life, even if it's not formal or taking exams. It's a great gift.
Exactly. Well, thank you again for being on. We really appreciate it.
Anytime. I'll see you next winter. Of course, in Los Angeles, winter is the same dang thing as fall and spring, so whatever.
Well, don't rub it in, but thank you. We'll see you soon.
Thanks, Jim.
I absolutely love talking to Eric. I could ask him questions all day. He just had such a deep knowledge of the economy and what's going on, and he also delivers it in an entertaining way. I know I kept talking about his newsletter, but it is fantastic because it gives you all the information and it's entertaining to read. And I do get a couple other newsletters from people, and they're great. They're informative. They're deep, but it's just dry because it's economics, right? But Eric makes it interesting. And that's why I like having him on the podcast, because he really cares, and that shows, but he also has great information, and it comes in an entertaining way. A couple of things that he talked about, one was consensus. When everybody is thinking, hey, this is going to happen, that almost means the outcome is likely going to be different than the experts are predicting. So that I don't know what to do with that, other than if everyone's saying, hey, this is what's going to happen, then maybe I think, well, okay, that thing's not going to happen. Maybe it's going to be something else. And, we always talk about the sponsors having skin in the game, and that's important. But really, in this time, you really got to make sure that they have significant skin in the game. We always say skin in the game, but we want it to be significant. Eric says he's usually one of the largest investors in his deals. Well, that makes a huge difference. Eric talked about a capital call and how hard that was for him to do. But, he's writing a big check along with that capital call too. And so that means interests are aligned, and it makes sense. And we're all getting, having to figure out, are we going to participate in this capital call? Are we not going to participate? And, you got to re-underwrite every deal. But one of the things I have started asking is, what what's your participation in this, Mr. and Mrs. Sponsor? How much are you putting in? And you got to know that they are confident in their own deal, and it's got to be a significant amount to know that that's where they're going, that they don't think this deal is going to fail. They're just kind of pushing the can down the road. No, they are committed. They're committed to their business plan. And when you're looking at that, you got to make sure that the business plan is actually going forward. We're seeing some of these operators who just gave up. They said, interest rates went up, so I'm not going to do my business plan. I'm not going to rehab these units. I'm not going to put in the dog park. Well, there's no excuse for that. You got to do the business plan. And if you're doing the business plan and interest rates or insurance or some other event that you didn't think was going to happen, happened, and that's why you're doing the capital call and you're putting a bunch of money in it yourself, and you have a business plan that you've been executing, okay, then it makes sense. Maybe we'll participate in that capital call. But those are the things you got to look at. And, this episode, we haven't titled it yet, but I think uncertainty is going to be in the title, because that's what we're talking about. Everything is so uncertain now, and that there's risk in that and there's opportunity. And what we need to do is go find the opportunity. So again, we'll have Eric on again. I just love talking to him. He's a great guest. So that's all we have for this time. We'll catch you next time in the left field.